So what comes first, the money or the company? In a SPAC, it's the former. SPAC stands for Special Purpose Acquisition Company and is often characterized as a shell company due to having no business operations of its own. Its sole purpose is to raise money through an initial public offering to acquire another private company and take it public. So, how does a SPAC raise money? Since a SPAC has no business operations at the start, a SPAC sponsor is responsible for convincing investors to invest in the SPAC. Sponsors are often incentivized to do so because they receive what is called a promote. The promote consists of founder shares, typically representing 20% of the SPAC's equity, and is acquired at a nominal cost. With this incentive in place, sponsors can then take the SPAC public through their own IPO. Generally, SPAC IPOs are priced at $10 per unit, with each unit typically consisting of one share of common stock, a warrant, or a fraction of a warrant. Put simply, a warrant is a contract that allows the holder to buy more shares in the future at a certain price. Investors can redeem their shares for cash and still keep their warrants if they oppose the merger, allowing them to still benefit if the company does well later. The funds that are raised are then placed in a trust account representing the amount available to fund an acquisition and can be invested in short-term government securities and money market type instruments. After raising capital through an IPO, the SPAC then has 18 to 24 months to identify a target company and complete the acquisition. Otherwise, the SPAC will liquidate and investors will have their money returned. Once a target company is identified, the SPAC shareholders will vote on a merger. In this time, SPAC shareholders may retain or redeem their shares. Upon shareholder approval, the merger is executed and the former SPAC becomes a public company, and this is known as the de-SPAC process. However, as the deadline approaches, SPAC sponsors may favor a bad merger in order to avoid liquidation and protect their promote. This direct risk to retail investors is why new regulatory rules were created by the SEC.
After 2 years of intense scrutiny, the SEC has issued a sweeping set of rules that reshapes the future of SPACs. Although SPACs deeply informed from the traditional IPO, these new policies help close those gaps. For years, SPAC sponsors have facilitated billion-dollar deals, amassing large profits while remaining invisible for public investors. Regulation 1603A changes this. Sponsors are now required to give information about their background and qualifications, and any financial compensation received for the initial investment. This impacts different stakeholders. Sponsors must now justify financial actions when there is a conflict of interest with the public, and also disclose any arrangements made behind closed doors, which may have advanced their financial positions. On the contrary, public investors, previously the least informed stakeholders within a SPAC deal, gain a clearer view of dilution risk and the motivations behind sponsor funding. Thus, the overall effect is a SPAC process that moves closer to the transparency expected within a traditional IPO. Additional regulations require target companies in the SPAC transactions to become co-registrants and be treated as issuers of securities, making them legally responsible for disclosure accuracy and reporting to public investors. This shift has stakeholder impacts. Target companies are now required to sign legally binding registration agreements. Executives and directors of said companies also face increased personal liability per Section 11 of the Securities Act. Additionally, SPAC sponsors may see longer timelines and higher compliance costs as a result of requiring advisors and legal risk representatives to apply IPO-level diligence throughout the process, with the winners being investors who gain stronger protections and clearer accountability. Under proposed item 1606A, SPAC IPO underwriters would have been deemed statutory underwriters in the SPAC, exposing them to Section 11 liability for material misstatements. An underwriter is a party that helps structure a deal and can be deemed a statutory underwriter based on conduct, even without formally being named. Because 1606A was not adopted, liability is not automatic. Underwriters now face Section 11 exposure only if their actions meet the statutory definition, giving them more flexibility and prompting more cautious behavior. This creates a gap for public investors who may have limited recourse if underwriters avoid that classification. Thus, these are some examples of the new changes implemented by the SEC.
As Anson explained, a lack of underwriter liability creates some legal uncertainty for investors. So how does the SEC address that uncertainty? Well, it does so by raising the standard for financial reporting, and now we'll explore some key outcomes of that. The first major improvement is in audit quality. To support the disclosure goals of Subpart 1600, the SEC also introduced Article 15 of Regulation SX. This article ensures that a target's financial statement are subject to the same audit standards as a traditional IPO. In practice, this means that investors can finally compare a target's financial statement with other IPO firms using independently verifiable numbers. From a conceptual framework perspective, this is a huge step in providing comparability, supporting the SEC's goal in reducing the risk of investors being misled by unverified projections. Another key outcome is in the reduction in the information asymmetry between sponsors and public investors. Under the old blank check model, sponsors controlled their disclosures. Now, with co-registrant status, the target company is legally liable for its disclosures under Section 11 of the Securities Act. This shifts responsibility onto the target itself, resulting in more neutral and reliable disclosures. This is a massive win for investor protection, as they can now assess future cash flows based on the target's information, not the sponsor's messaging. Finally, projections have become far more realistic. This is because the PSLRA safe harbor has been removed, which used to protect companies from being sued over misleading forecasts. Without this shield, projections now carry a strict liability. This forces companies to provide more faithful projections rather than aggressively optimistic forecasts. Together, these reforms encourage a high-quality financial reporting that strengthens investor protection, creating a safer SPAC market for all of us.
Now, the implications outlined by Cheyenne are vitally important, as without the new ruling, retail investors are severely disadvantaged in the SPAC market compared to other actors such as venture capitalist funds, who in a recent study was observed to be using SPACs as a vehicle in order to offload their less profitable assets and prop up its value. They capitalize on the vested interests of sponsors, the disparity of information, and the lower standards of reporting in order to obfuscate the true value of their assets and size up the exit profits. Now, this was so prevalent that venture capital-backed SPACs underperformed their projected benchmarks by 45% greater than independent SPACs. Article 15 of Regulation Essex mentioned by Cheyenne is also critical, as it reduces bad practices such as those of Clover Health and Nikola Motor, where both parties inflated their projected offerings and intentionally hid ongoing DOJ investigations in order to garner more retail investor interest. However, under the new rules, they will not enjoy PSLRA safe harbor and would suffer personal liability. Now, the third regulation I wanted to mention, 1603A, is critical as it improves transparency and fairness for retail investors, as it will expose the interests of sponsors like Chandran Pratyaya, the SPAC King, and allow investors to weigh their opinions more accurately to their interests. Now, coupled with the target companies being co-registers, it would prevent cases such as Cantor Fitzgerald or Trump Media and Tech, where both parties begin negotiations with the target company to provide themselves with an advantage over retail investors, and would incentivize such companies to have more prudent disclosures.